Good afternoon, everybody. Welcome to your Monday edition of the TraderMerlin Show. It is the 25th of July today, a calm, quiet day as people get ready for the FOMC announcements this week. So good to have everybody with us. I know it's Monday. It's going to be quiet, but we should have some fun on the show. Quick shout out. We got Gary from Phoenix. Are you triple digits, Gary? You've got to be triple digits. I'm 80 plus here in Orange County. We got Randall who's sweating it out in San Diego, though he's got the beach right next to him. Good to see you, Thomasina, Glenn, Katut, Eric, Les, and others will be joining us here in a little bit. I won't say a shout out to everybody because, well, some of you are lurking behind the scenes in the shadows. So, I had a bunch of questions. I usually get a pile of questions that pertain to a specific topic, and today I decided I would just go ahead and do this one. I was going to try to get Dr. Woody Johnson on the program, but I just didn't get a chance to get in touch with him. So here's what I'll be talking about today: is trading is 85% psychology. Deal with it. Now I know this number is. Where are you getting this number, Merlin? You know, it's where's the actual fact to back this up? You owls out there are going to go, I need to see the statistics that say it's 85%. Look, every book that I've read, which is not a lot in the trading world because reading bores me. I'd rather get my hands dirty by actually doing something than be book smart. So every book that I have read points to between 70% and 100% psychology. And I think you'd all agree at certain points in time, it's much more psychological. In particular, in my case, and maybe some of you resonate with this, maybe you don't, is when I'm on a losing streak or I start to lose, and that's when I get this landslide of emotional issues, psychological issues, which could lead to substantial losses down the road. So we'll talk a lot about that today. Had some fun with the graphic there. The guy just prying into your brain to dig in there and see what's really causing it to tick. A lot of it is how you deal with situations. So I'll talk a lot about that, but I do want to go through our top 7 here just to get things rolling. Here we'll start things off with Bitcoin at the bottom of the list, which is not looking good. Right? It's not looking good. If you see the downward move over the past few days, I was kind of hoping we'd stop right around this 23,000 mark. Well, we drifted below it today. We're at 22,185. Pretty much 3 days in a row of just down moves here for Bitcoin. And again, what does it mean? I've been saying this pretty clearly, as I still believe there's downside move here. I think that we have some shakeout from all the lending protocol stuff and just other issues which could push Bitcoin down further. I was excited to see this break, really wanted to see this break and a bigger move to the upside, but just didn't come to fruition. So at this point, I expected to kind of keep drifting back down here until there's some catalyst for an upside move, and I just don't see anything right now that's going to cause that. So Bitcoin down 1.9%. Really from Friday's close. That's the Bitcoin futures for the day. It's a little bit different, but that's the difference between a futures market and a spot market. This market that you're looking at here is closed on the weekends, right? Closes Friday, opens Sunday night. This chart of Bitcoin, right? Oh, great. Don't have them alphabetical. Let me just bring up Bitcoin for you. This chart of Bitcoin here is 24 hours, 365, never closes, never pauses, never does anything other than move. And you can see the picture is telling the same story, maybe more dramatically, because what's it been doing? It's no longer 4 down days or 3 down days. It's 1, 2, 3, 4, 5, 6. Right, stretching that out, and where's it headed? Probably down to 21,000, which actually the tails today hit that level as well. We had a low of 21,564 for the Bitcoin spot. Right now it's at 22,148. All right, that was your bottom fisher. Your laggard there was Bitcoin. We'll move our way up that ladder. It gets a little bit better. Here is the NASDAQ 100. I did not close out. I am still short. Yeah, it was snooze fest, right? I do think that you're not going to see much until the announcement on Wednesday. I think that's really when the tires meet the road and we get some clarity. Now, granted, most of us are anticipating a 75 basis point increase, but that could be a surprise on Wednesday. You just never know. So here is the NASDAQ 100 was down 0.79% on the day. We had this line here drawn at 12,247, and as I mentioned, when you have a breakout like we did here on the 19th of July, it broke above that overhead supply level, right? I've got all kinds of lines drawn here. Let me just, for posterity, take some of those away. But we had this ascending triangle that was forming, really started back on the 16th of June, and then we bottomed again on the end of June, and now we bottomed again on the 13th and 14th of July. So it was getting better, right? This uptrending line, therefore, breakout move to the upside. However, we shot in this yellow area of supply, which for me, I took the chance and went short. I've got a little gain on my profit, nothing that's huge at this moment, but it's kind of that pivotal moment, right? This supply zone, or this initial break above this red line here, was theoretically a supply zone because it had difficulty getting above it back on June 27th, as well as on July 8th. Well, we ripped above it on the 19th of July, and then the question is the retest. We got the retest today. Now, the bigger question is, does this hold? Does this retest of 22,249 hold, and we start to move back up, at which point I will have to get out of my short position? Or does this continue back down, disrespecting this current demand zone, and go back towards this trend line? I'll move this trend line out here a little further just so we can see where it might end up. And that's what I have to contend with this week. This will probably be my swing trade planning for the week, is how do I deal with this NASDAQ trade if it bounces aggressively tomorrow or if it continues on down. On the day, down 0.77 right now as it's changing in the after-hours session. All right, moving up. You would think it'd be another index, but it's not. We've got gold and silver also got crushed today. Here is that gold chart. This is the futures. Again, I just feel like there's not a lot here to act as a catalyst for gold, especially if that dollar index keeps rallying. Gold on the day down 0.53%. 1,718 is where we closed at for the GC. All right, back to some indexes. S&P 500, a really boring day. You can see this spinning top formation here. Really was not the widest of ranges, fairly compressed. We can add on volume here for the S&P futures. You can see lower than it has been over the past few weeks. Therefore, clearly showing that the vast majority of people are just sitting there waiting for the FOMC announcement. So we'll call the S&P unchanged. Same thing with the Dow, an even tighter spinning top right at the closing price from the July 22nd session. Gary, you said, which do you buy? I don't trade the Bitcoin futures. I do spot. I'd rather physically own Bitcoin, and I'll move it over to my cold storage wallet, which is one of these little nano ledger devices, and keep it there until the dust settles on the lending stuff, and then I will probably move it over to some lending exchange to earn yield on my Bitcoin. But that's down the road right now. Get everything onto cold storage and control your private keys. All right, so we were on third place with the Dow, which is unchanged. Russell 2000 posting a slight gain. You can see it differed from the Dow and S&P, and that it had a green candle where the other ones were kind of, just a spinning top doji, meaning it opened and closed at the same price. Well, the Russell was green, meaning it closed slightly higher than where it opened up at, therefore giving it a 0.33% gain as we speak right now. But that wasn't your big victor. Big victor was crude oil, right? We had that nice sell-off as it hit this trend line for the fourth time. Sold off aggressively right back down to this 93.60 mark, which was kind of mapped out. We hit that again today. Again, with the trend lines, it's a question of, are we going to come back to this trend line? I'll make it even stretched out here a little bit further. That is where it should, oh, come on, it's jumping around on me. It should be right about there, right? So we'll leave that trend line on. Actually, I'm sorry. As you guys can see, that shouldn't be there. It should be right here. It should cut through these 2 points up, higher up. So I'm using my anchor point for this downtrend line on crude oil. Anchor point is on June 14th. I'm running it through the point on June 29th, and then we get our third point for confirmation on July 5th, and you notice these most recent touches last week hit that downtrend line as well. So the question now becomes, are we going to see this trend line break here, or is the baseline going to break, which is right around 93.64, I think is what this line is right here. If that breaks, then all of a sudden we have to start looking way off to the left-hand side here for some demand zones that could be an attractant to price. But as you can see from this picture on a daily, it's been getting weaker and weaker and weaker since the beginning of June. So anybody who's long on crude oil, this is an inflection point for you, because if we break this, you could have some significant downside movement. That was your top 7, but I'll also sprinkle in the dollar index here. You guys can see that the past couple of sessions for the dollar have been relatively small, no big changes. However, it's down below this yellow box, which leads me to believe that the higher probability is we're going to keep drifting down and go from 106.50 down to about 105.10 is where I have my line drawn here. So still some downside movement here for the dollar index, which of course dollar down means market's usually going to go up. I say usually because, as you know, everything works until it doesn't. Now lastly, let's just real quickly look at the bond markets as we talk so much about that. Here's the 30-year and the 2. You can see just crazy wild swings over the past couple days. This is the yield curve from the 30 and the 2, but normally we're going to be looking at the 10 and the 2, and you can see we are still inverted on the 10 versus the 2-year, and we are still inverted on the 10 versus the 1 year. So these are pretty important things to look at with regards to yield and markets going forward. Normally when you go inverted, it doesn't stay very long. Well, here we're seeing not only are we inverted, but it's been staying like that for quite some time. Been almost 2 weeks now of just staying inverted. Not usually a good thing. All right, that will do it for our top 7. If there's other things you guys want to talk about, please feel free to type them in the chat. I will go over whatever we can today, time permitting. So today's session was driven by, I think I have 2 or 3 questions pertaining to this topic. So I'll give a shout out to Echo and I think, what was the lady's name? Tiffany. I'm going to read them both just to get them out there so I make sure I cover everything. So here is the first one. This is from Tiffany. It says, any suggestions on how to deal with a losing streak? Yeah. I have a lot of suggestions on how to deal with a losing streak because I've gone through a tremendous amount of losing streaks in my day, and you just have to figure out how to claw your way out of it, right? The worst thing that you can do is to keep swinging or swinging even harder because you dug yourself in this pit for a reason. Last thing you want to do is keep doing the same thing more aggressively in the hopes that you're going to get out, right? So first thing that I would suggest with anybody who is on a losing streak, mentally a couple things are going to happen. And everyone here can relate to it. If you guys have ever been on a bad losing streak, feel free to share your stories. But for me, what happens is if I lose on a trade, it's no big deal, right? As long as it's within my parameter. So as you guys know, as a day trader, I had a $500 per day stop loss, $250 per trade was my day trading rules. So as long as I stayed underneath the $250 loss per trade, I was okay with it. Now, granted, nobody wants to lose. I wasn't like, hey, yeah, I lost $250 on this, but at least I didn't lose, $5,000, $10,000, $15,000 on the trade. So $250, fine, I'm okay with that. Now, let's say I did 2 trades in a row and I hit my $500 stop loss for the day. Okay, fine, I'm out. Obviously, I'm upset about that, but it's not enough where I start throwing stuff around the house and I'm a totally different person. Now, if I, let's say, lose 2 or 3 trades in a row, but I'm way past my stop loss, right? I was just stupid. I didn't adhere to my rules. And now let's say I lost $1,000 per trade. Well, now I'm down $3,000. And here's where it really started to take its toll on me. What happened is I would become self-defeatist and I would beat myself up. Oh, you freaking idiot. You moron. How could you do that, Merlin? You know your stop loss was $250 per trade. And here you're losing $1,000 or $2,000 or $3,000 per trade. And then I would beat myself up to the point that I started to convince myself that I was a failure, that I was a loser, that I was no good at this and I had to quit, That type of thing snowballs very quickly. If you are a negative Nancy and have a defeatist attitude, trading will kick your butt so bad that you better either seek a therapist or figure out how to fix that problem. Because if you're negative and you think that you're always going to lose, then you're always going to lose, and just may as well just email me a check for all the money that you thought you were going to lose. Just send me the check for that amount and I'll give it back to you at a later date with some interest taken out of it or a bottle of whiskey taken out of it. So as far as dealing with losers, here's how you do it. You need to set up a rule or a strategy for when it happens. Not a question of if, but when we go on losing streaks. And I go for every single person that's in here. Some of you are very experienced. Some of you barely started trading. I don't care. You're all going to have a losing streak. It makes no difference who you are. It's like saying that I'm going to catch a cold sometime in my life. It's going to happen. Some might catch colds much more frequently than others. A horrible analogy, I know. So when it first happens, you got to say, okay, I need to stop. So number one is have a specific amount that you're willing to lose per trade or per day so that you don't get to that point of disgust and self-defeating, right? Number two, if you lose a certain amount of days in a row, you should also have a stop, meaning you stop trading. So I have it where if I lose 3 days in a row, if I have negative 3 days in a row, I have to take 2 days off. Why? Because if I have lost 1 day and I hit my daily stop loss, no big deal. I hit it the second day, my brain, whether I like it or not, is going to start to beat me up and go, man, you're really struggling. And what will happen to a lot of traders, let me know if this has happened to you. All right, just say yes or no in a chat as I finish this story. You lose on 1 day, and let's say you hit your stop loss of $500. You lose on the second day, and you lose another $500. And your brain tells you, man, I better double my share size because I got to make up that $1,000 I lost. So I'm going to now trade double or maybe even triple, and I might even trade something more volatile than normal because I have to make that money back. How many of you have done that in your trading? Yes or no? My guess is most people are going to say yes, and this is going to sound very sexist, but studies show that technically women make better traders. I know. I'll explain why. But most guys will be the ones who pile on more risk. The women tend to just say, okay, I'll adhere to my rules and I will stop out. And I say that in general. I'm certain there are some very aggressive lady traders and some very passive men traders out there. But so I got some yes. I got 2 yeses, 3 yeses. The market is wrong. I am right. Yeah, Gary. That's the one. Or you start cursing someone like Goldman Sachs. Oh, damn you, Goldman. God, you took my money. Oh, that's their job, is to take your money every day, right? So good. I'm glad to see everybody's done. Thomasina says nope. Oh, well. You brace yourself, Thomasina. Brace yourself. You're probably going to do it. But no, there's the lady in the crowd saying, nope, not going to do it. I used to do it early on. Good. But you learned right away, Big Eb, that is one of the biggest recipes for disaster. Because if you double you're losing for a reason. Whether it's the market dynamics, whether it's the security that you're in, whether it's just poor mindset or risk management or bad trade plans or bad supply and demand zones, who cares? You're losing 2 days in a row. But our brain will say, well, I'm going to get it back on the next pitch. I'm going to swing for the fences. And next thing you know, you lose $5,000 a day. And all of a sudden, it's worse and worse and worse. An analogy I like to use is Derek Jeter. So Derek Jeter, who is one of the best pure baseball hitters of my generation, batted .315 lifetime. And he's going to go straight to the Hall of Fame. .315, which means that he failed 68% of the time. Now, whether that's popped out or ground out, who cares, or struck out, he failed 68% of the time. He only succeeded 31.5% of the time, and he's going to go straight to the Hall of Fame. For us, we can do a lot better than that. The difference is, when we strike out as traders, the extent to which we strike out fluctuates. That strikeout might be a $100 loss, or could be $50,000 loss. For Derek Jeter, it was, I swing, I miss, I go sit on the bench, and I wait for the next at-bat. It's that simple. And I think for us as traders, and for Tiffany out there, I think you need to treat it that way as well. The next time that Derek Jeter came at bat, he went on a streak where he was like 0 for 36, which statistically is such an anomaly for someone who hits 30% of the time to go 0 for 36. 36 plate appearances and didn't hit the ball once? Crazy, right? Didn't get a base hit. However, it's a statistical anomaly. I'm sure he had other periods where he hit the ball 36 times in a row or something like that. So, you can't approach that next trade as I have to do something different. You have to go back to what works for you and worked for you in the first place. And that goes back to your trade plan and your rules. Revenge trading can be extremely ugly. I've got some serious learning lessons from revenge trading that may scar me forever, where I was just upset at the stock, upset at the market, upset at some news that I traded off of, and ultimately I was the one to blame, but I went back with bigger share size and just got my ass handed to me. This is one of the main reasons that Apple is on my you can never trade it list. Right? There's only 2 securities, specific securities in my trading plan that I can never trade ever again. Apple is number 1. That's been there since I think 2000 or maybe 1999. The other one is Cisco because of a trade that happened in 2001. Other than that, you guys know biotech and pharmaceuticals are also off that list as well. And I have no problem omitting things and saying you can never trade that again. Who cares? Just get it off my list. Go with what makes you money and what works for you, period. All right, I went on a long random tangent there, but yes, before rules were established, good. Echo, this is mainly this shows because of Echo, so we can thank Echo here. You need to have probabilistic thinking. Correct. And certainly, I think if we approach trading as a probability game, it's going to do you wonders, right? If you're a gambler and you're like, oh, I'm just going to keep trading and eventually I'll make money, you're going to eventually lose everything you have. If you don't have rules or structure or a plan in place, you're probably not going to get any form of consistency. Now, I'll be clear to everybody. Obviously, I teach for Online Trading Academy, and I'm a student of Online Trading Academy back to 1998. So obviously, I believe in the methodology and the content and the approach. However, that said, it doesn't mean that you can't be successful if you go to different schools, right? To me, the foundation. I was just talking with Don Dawson today, and yes, Don will hopefully come on the program here in a couple of weeks, and we'll talk commodities. But we talk about the foundation, and I know most of you are probably Online Trading Academy graduates. That's fine, but if you're not, it makes no difference to me. But you all have to have a set of foundational rules that is the support structure for your trading style. And your trading style may be somebody like David Warner, who uses price increment points, right? 10-cent intervals and 25 and 50-cent intervals. You might be somebody like myself, which is kind of a hybrid of supply and demand along with technical analysis. Or, you might get someone like Kayla, who is pure supply and demand strategy. Somebody else might be using nothing but indicators or using just Fibonacci or Bollinger Bands. Every strategy has their merit, but you have to figure out how to form that on top of your foundation. That foundation has to be discipline, money management, risk management, etc. And from there, Tiffany, I think you can deal with your losses. So ultimately, it's saying I have to punish myself if I start to go on a losing streak and prevent it from turning into this colossal downward spiral that just erases your account. And I'm sure some people in here have suffered through that, where you keep trading through the bad trades, you think you're going to get it back, you trade bigger, and next thing you know, you're like, I don't have any money left. Well, we can't let that happen. Now, one thing that my mentor told me early on, and I think it's kind of silly, but psychologically, it's critical, and that's this. Tiffany said, any suggestions on how to deal with a losing streak? Well, I mentioned that if I lose 3 days in a row, I have to take 2 days off, right? So if I take those 2 days off, I have this mindset that I might still lose when I come back after that 2-day break. So if I'm lost on Monday, lost on Tuesday, lost on Wednesday, I'll take Thursday, Friday off. At the time, I would just go read books on trading and investing, and I come back on Monday and start all over again. If you still are in that losing streak mentality, scale your wager back and go all the way down, like the smallest bet that you can make. In equities, it's 1 share, right? Unless you're going fractional, and let's be honest, don't trade fractional shares, just trade real shares. So go back to 1 share of something. And my mentor was like, listen, it's not about making money at this point. You have to change your mindset, because your mindset says I'm a loser. I keep losing, I'm losing money, I'm a failure. You have to kick that out of your head, because if you think that way, you'll lose until your money is completely gone and your account's at zero. So by trading 1 share or going back to the smallest amount that you can trade, he says, all I wanted to do was have like just a penny profit. And my brain says, okay, you won on that trade. And all of a sudden, he started to get that positive aspect up again. To me, that is really important. You have to stop something. You have to do something to prevent that defeatist mentality. Otherwise, it will erode everything you got. The other one here is, and this is not necessarily dealing with a losing streak, but it has to do with egos. And I've dealt with, I've had people on the trading floor that had egos that were the size of Australia. I mean, they were just gigantic egos, and they always thought they were better than everybody else. One thing I've learned in trading, and you guys have probably witnessed this through this show over the years, is there needs to be some humbleness to you and your trading, right? Don't brag about the winners. Those are all just doing what you're supposed to do. As a matter of fact, you should be bragging about your losses, because it will reinforce what you should be doing. And that's something that really has helped me over the years. Is I love talking about my losing trades. I don't really talk about my winning ones too much, because I didn't do anything special. I just did what I'm supposed to do, right? If an engineer or an architect is supposed to build a house and he builds that house perfectly and everything goes great, does he visit back and go, man, I nailed it on that house? Maybe a little bit every now and again, but you're just moving on to the next project. Right? It's the failures that we have to address and move forward from there. So that was the Tiffany one. Let me go to the Echo question. And the Echo is what set this all up today. So Echo, thank you very much. He says, can we talk a bit about psychology today? I scared myself out of 2 trades this week. And that was, by the way, it was last week that this came in. So this is a little bit lagging here. So I apologize for not getting into it right away, Echo, but here we go. I talked myself out of 2 trades last week that would have made my month. I placed the order and shortly after decided to cancel the trade. It's within my risk parameters, but I convinced myself not to take the trade. I think today's excuse I told myself was that the dollar was in a demand zone and I shouldn't take the short, even though the profit potential was superb, which is one of my reasons to take the trade. My question is, what are some things we can do to stay confident with our trades and not shy away? Great question. This happens to me happened to me all the time. I will say, I definitely think I've conquered this beast, but every now and again it will rear its ugly head. Now, I'll ask you 2 questions here, Echo, and this is for everybody that's with us today. If you had a trade perfectly mapped out, and you look at it and you go, man, this is a great trade, and all these different reasons, but something convinces you not to take it. And you go, you know what? I'm not going to take that trade, right? So you don't take the trade, and let's say it's going long. You don't take the trade, you're like, okay, I'm just going to pass. And all of a sudden, a couple of days go by and that security is down 20, 30, 40%. Do you look at it and go, dude, I nailed it. I was on it. I'm so glad I didn't take that trade. I trusted my gut. I went with it. Most of the time we don't. Most of the time we're like, oh, okay, whatever. I'm just going to move on. The other side of it is what Echo suffered, which is I mapped it out. Things look really good, but I talked myself out of it. And then it does what you thought it was going to do. And you're like, son of a biscuit. I can't believe, and you get angry at yourself. It's those 2, devils and angels, if you will. On one side, you've got you followed your gut and you're glad that you did, but you don't pat yourself on the back for it. The other side is you followed your gut and it did what you thought it was going to do, which is just go straight up and make you a bunch of money, and you regret it and you shame yourself for it. So what I would say, and this is probably very similar to what we saw with my QQQ trade last week. So last Thursday, you guys know I shorted the Qs. I basically bought some puts. And it's similar to this, because if I look at what you wrote here, Echo, you said, 2 trades last week, could have made my month. I placed the order shortly after I decided to cancel the trade. It's in your risk parameters, but I convinced myself not to take the trade. And for example, you say that the dollar was in demand, right? So don't take the short. Well, look at what the triple Qs did last week. Let me bring this over here for you guys to see. And I've pointed this out a few times, but we've got things just drifting lower. I'm totally going against the grain. So what I probably most likely would have done is talk myself out of this trade right here, right? So there it comes into supply. As this thing is rallying up, I should be more bullish. So I had all sorts of reasons why I wanted to talk myself out of this trade. But all I did was simply look up here and say, if it gets above the 315, I'll stop out. And that'll probably cost me, based off 30 put contracts, it might cost me, $500 somewhere in there, especially because I've got October, so I got over 90 days. So I analyzed the risk and said, I know it's risky, but I am basing the probability off the bigger time frame. So if it was wrong, am I okay losing 500? In this case, I'm okay with it. So what did I do? I made the trade. In your case, I think you should have taken the trade, even though that dollar was at demand. And we can go back here, right? You've got this dollar at demand, right? We actually kind of broke through it here. It's a little bit below demand. What I'm looking at for anybody who's on the podcast is the dollar index on a daily going back to July 19th, 20th, and 21st. We were kind of sideways, in my opinion, slightly below this area of demand, but, it was consolidating. And Echo's thought was, well, it most likely is going to bounce here. And I agree with you 100%. I thought it was going to bounce here. That's why I put that zone there. But it didn't, right? So I think from a psychology perspective, I'm okay going counter trend. I'm okay going against sometimes what I think is going to happen, as long as I can justify it from a perspective. So going short the NASDAQ on a 4-hour chart didn't make much sense. Because if you look at the 4-hour, let me just bring that up here. So let's say, I maybe even go lower. Let's go to the hourly. All right. Going short on the hourly doesn't make much sense. I mean, we are rallying up into supply. So on this intermediate time frame here, let me take out the just regular hours trading. This isn't the greatest area of supply. It's really kind of wide. But you can tell from the price action here from mid-June through just a couple days ago, this thing's real strong. So I was clearly going against the trade. I was going a low probability trade. And the primary reason was the bigger picture, that daily time frame. So, Echo, what I would say here from a psychology perspective is, if you're making a trade that something is convincing you not to get out of, or not to get into, okay, fine. But I certainly would revisit that and try to look at things from both sides and evaluate. Say, was I wrong to be looking at the dollar index in that situation? The answer was probably no. I think you were correct in looking at the dollar index. I think the issue here was the risk reward worth it? And if you had a good reward to risk ratio and you knew what your stop loss was and it was only going to be a little bit, then maybe take the chance. I'm one that will always take those, not always, the vast majority of the time I will take those chances as long as I can justify it. So for example, back to this longer time frame, if this was in an uptrend and we came into the supply zone like this, would I take the trade short? Yes. I would still take the trade short on the long term. I'm simply playing this zone, and that has defined risk for me. We could end this market by the end of the week. Hell, we could be at 330 on the Qs if this FOMC announcement comes out and just wows everybody. Or we could be much lower. So I know that there's generally a lot of gyrations and wiggles here in the markets that happen. I would say next time, in your trade planning or trade journal, write down the reasons why you decided not to take that specific trade, and then reevaluate it and say, okay, I didn't take the trade for these reasons. Could I maybe have changed it, or what may have been a positive factor for me making that trade? I think in this example, Echo, you may have put too much emphasis on the dollar index and said, that's absolute. Well, there may have been some other factors there which could have given you more support in your decision. I know I've used this analogy many, many times, There's an old phrase that says, if you torture a chart long enough, it'll tell you whatever you want to hear. One of the analogies I like to use is, is anybody here in a relationship or married? Ultimately, you had to make that choice. You had to choose that person and say, this is the one. But, one thing that you can do is you've chosen that trade based off of your belief systems, whatever. There you are, right? You're now with this individual. And let's say it's talking about a girl. Let's say I found a girlfriend and everything's great and I made that choice. Well, one thing that you can do is you can, parade her around or bring her around events and introduce her to your friends. And those are technical indicators. Your family, technical indicators. And if, cousin Bollinger Band says, hey, she's perfect, this looks great, or the Uncle Dixie over there is saying, hey, this looks great, you start to become more confident in that trade. However, there's also situations where you walk around and in this case, I'm doing a relationship analogy to the markets, but you might look at something like stochastics or Bollinger Bands or the Dixie, and they all look like, this is terrible. Oh my God, what are you doing? You're going totally against the grain. That might cause you to not make the trade. But I think if you look at, when you look at that picture, I think there's a lot of reasons which may have allowed you to take that trade, but I think you may have talked yourself out of it because of what the Dixie was saying, which is okay, but the Dixie is one component of many, right? I don't know if that helped you at all, Echo, but I think psychologically, just objectively look at all the different tools that you're using. Now, if you're just using the dollar index, I might say, look at some other factors, right? Because that's just one point. If I could say I'm using the dollar index as a odds enhancer, but I'm also using supply and demand methodology to make the trades. Great. Maybe I run through the odds enhancers and see how that applies to that zone to get my confidence up or down. I'll add on the dollar index. I'll add on stochastics or Bollinger Bands, MACD, candlestick formations, whatever you want. At some point, you might have a fairly mixed bag. Now, if everything is saying don't take the trade, then I'm probably going to side with don't take the trade. Let me scroll back here because I know I got a lot of stuff here. Don't ever grow up, Tom. He says, when I grow up, I want to be like Thomasina. No, you don't. You want to be like nobody. Let's see. Joe says, I have a beautiful habit of being ahead dollar-wise and getting into sketchy trades, reducing the profits. Any advice for that? Does that count as over trading? I'm not quite sure I understand, Joe. Are you saying that you make trades and then you're like churning the account and making more trades and that eats away profits? Or are you saying that you're in a trade and it'll move against you and you give up a lot of profits? Those are two very different things. I've mentioned this one before. I'm a huge fan of peeling some off if it gets to a price target, right? So if I have, your entry, your stop loss, maybe multiple price targets, great. If it gets to your target one, best thing you can do, just take some off the table. That's why you're banking that cash. And if you do it correctly, you can allow that position to move a lot more and still come out with a profit no matter what. I think what happens all too often is people get greedy and they don't take part off. They want to let the whole thing ride, and all of a sudden it starts to drift down a little bit, and then they don't want to lose. And next thing you know, it keeps dropping. Now they're back to break even. It keeps dropping. Now you got a big loser on your hand. Lock in something and just say, all right, I know I'm going to take some money off the table. I'm going to go home with something. That, to me, that's been a huge factor for me over the years, is the ability to just say, I'll take some off the table. And I know there's certain individuals who shall not be named, Voldemorts if you will, that say, oh, I hate the phrase, you'll never go broke taking a profit. That it's wrong. Well, I don't think it's wrong. I think it's, depending on how big of a profit you take, you should do well over time. Now, if let's say I'm long, we'll just make it up here, I'm long Google, right? And Google moves up 50 points, and I'm long that entire move, right? I got 50 points of the profit, and then it drops back down. And now I'm only up 25 points. I'll probably close the whole position out, especially if it's no demand zone nearby. Why? Because I want to make sure I'm taking something home. It's demoralizing psychologically. Going back to our 85% psychology, sometimes it's 100. It's demoralizing if you've got a big profit on, and next thing you know, you just let it drift against you. Drifting, and the end of the day or week or a month, you're taking a loss on that trade. I mean, that is probably the worst thing to happen. Absolutely, just you beat yourself up over. You're like, God, I had such a great profit. I was up $1,000, and I went home, closed it out and lost $500. That's brutal, all right? Even if you just locked in $5 of the profit on that trade, great, you made something. I think that is part of it. Now, you'll probably kick yourself for the money that you gave back, but don't feel bad about leaving money on the table as long as you're taking money off the table. Let's see. I can't use indicators. They sway me way too much. I just keep them off completely. Okay. You know, and Echo, I agree. I don't either. I mean, you guys have seen my charts here many times. Oops. How often have you guys seen me use indicators? I really don't. Every now and again, I'll flash them on the screen. But, you know, if you guys asked me, hey, Merlin, what's stochastics saying on the Qs or Bollinger's or MACD or RSI? I could tell you pretty much what they're saying. Just because you look at enough price charts, you'll know what these indicators are designed to do. Right? It's just a math equation, and these are my data points. And I can tell you what the moving averages at the 20, the 50, the 200 should look like without even having them there. And I agree. I think that they do sway your decision. But, you know, Echo and a lot of these, you know, right here, when we were right here in this supply zone, what do you guys think the Bollinger Bands were saying right here? Not Bollinger Bands. What is stochastics telling us? If I look at this price chart, and this is the Qs trade that I made last week, what are they saying? Are they saying that we're doing good? Are we saying we're overbought? Saying we're oversold? What are we saying here on stochastics? Let me add it on. I'll let you guys type it in. You think it's overbought, oversold, or just right, three little bears action? Right at this moment where I went short on this one, going against the grain. All right, I'll go indicators. I will throw in stochastics. Let me go, let's see, stochastics. Oh, they spell them out here. I don't want strategy. Interesting. There's stochastics, and I will show you. It was overbought, right? So at this point right here, it looks ugly because I'm going counter trend. It actually says overbought. Well, I don't need to put stochastics on here to know that. I know the formula. Stochastics takes the last 14 bars worth of data and says, where are we right now in relation to that range for the last 14 days? At this point, it's near the peak. Great. Totally overbought, right? Overbought. So that's one factor that helped me out here. I felt it was overbought, had a huge rally up, and we're right at supply. Even though I'm going counter the short-term trend, right? I had to. It assisted in my decision. Now, what messed me up and would have maybe gotten me out here is, well, the triple Qs are trending real strong. So go with the trend. Exactly, Joe, Alan, you guys all nailed it. Overbought. It's overbought. But we didn't need to put that on there. I think a lot of people use them as a crutch. And you can pretty much look at it on any price chart. I mean, hell, that was after the fact. So, you know, a lot of you are probably like, what's after the fact? Well, you know, look at something like crude oil. Crude oil right now is going to be near, it's not oversold because of where current price is, you know, using stochastic. Let me see if there's an example that really stand out and is an easy one. We already looked at indexes. Let's look at gold. Gold's going to be right around in the middle of the range. All right, it's just not really doing much at all. Bitcoin's going to be in the middle of the range as well. So, I don't know. And I think keeping those indicators off, as Echo had pointed out, is probably a good thing once you understand them, right? And once you understand how they function, what they look like, then I think that you can effectively keep them off your charts because it's just math equations. All right, what else did I miss? Can't use indicators. Seems like scaling out helped the psychology a ton. Yeah, it did for me. And I don't want to make this a show where it's like, hey, you have to do what I do. You have to find out what impacts you the least, right? So if you are if you're a type of trader that doesn't like to scale out, fine, or scale in. For those who don't know what I'm saying, if you're scaling and you're adding to your position, whether that's dollar cost averaging to a losing position or a positive, it's irrelevant. You're adding more to a position. Scaling out would be you're selling off pieces of your position. Some people don't want to do that. They want to sell all at once. Well, I think what will happen is you're going to get an S curve of profits and losses. And let me see if I can draw this real quick and show you what I mean. Let's go here. I got to add in a slide here real quick. The losing streak one's there. We'll add a new slide and we'll make that white. Okay, so let me bear with me as I do some horrible drawing. But I think that this is going back to my understanding of math and my love of math, is if you have a baseline here, right, there's your baseline. If you are going, and let's say this is somebody in red will be somebody who's not scaling in or out. So red, I'll just say all in and out. Right? So you're buying it all at once and you're selling it all at once. What I think is going to happen there is you're going to have these really big extremes, fluctuations of price. You have some big winners, some big losers. Now, if I change this, let me see if I can do this with different colors. Let's go blue. So in blue, you'd have scaling in it. scale, in, sorry for the penmanship, and out. What I think personally will happen over time is you're going to have probably a curve that looks like this. I think what you're doing is you're smoothing out the extremes. And over time, in my opinion, the blue line should win out. Because the bigger the drawdowns, these red big drawdowns, the harder it is to recover from those. So, in my opinion, scaling out says, yeah, I'm not going to catch the peak of the move, but I'm also locking in some profits. And when it starts to drop and you're an all-in, all-out kind of person, you're going to take much bigger losses. So that's how I view the scaling in and scaling out discussion. That's just my opinion. I know some people might differ in that one, but I put myself in the scaling in and out category. I think that that's just a better way to go. Plus, there's something that is euphoric about looking at your P&L for the day and you made money. Like actually closed out a trade and said, this is closed P&L, not open P&L, because that's dreams, and letting it go. I think that taking some money off the table is the best way to go. W&T offshore, don't know. I don't really follow crude other than just looking at crude oil, right? I'm basically just looking at CL. So this is light crude futures. There's different gradients of crude. My thoughts on going long, I think that it is probably a decent move. I kind of feel like you're going to see this crude oil bounce up here simply because it's compressing against the base. It's crude oil. We've already had a pretty decent sell-off. You can see this little blue trend line right here. You're looking at a slide of in 34 days, crude oil is down about 25%. So I think you're okay if you decide to go long on the crude oil futures here, and you have to look obviously for the different time frames, different charts for the different qualities of crude, because there's Brent and West Texas Intermediate, there's all kinds of different stuff. That said, you better have a stop loss in place. You know, if we get down below 91, in my opinion, I think that you could see a big sell-off. It's looking weaker, certainly for the past couple of months here, but going long and taking that shot, it could pay off, but it's just going to be risky. Make sure you have a stop loss in place. That's as simple as I can make it, NJ. I try not to complicate things too much. You know, this is almost the exact opposite of what I was saying with my NASDAQ trade that I entered last Thursday. In this example, the short-term trade is heavily down, right? Well, going long here looks really, really risky. However, you are coming right into this level. It has not been able to break since, 8 months? 6, 7 months? Since March. Has not been able to break down below this 93.60 mark. Great. At least it hasn't closed below it. So I'm using that as a backstop. If you are, fine. Just make sure that if you're wrong, you bail out of this one real quick, because you can see how strong the trend is down right now. And let's not forget, it's dollar index. The dollar index has certainly been having an impact on crude oil. No problem. Mentally, I think it's easier to let profits run when you take some profit. Correct. Because you pull one of these ones. All right, here's my theater of the mind. Not theater of the mind, but my actual theater. Oops. Oh, stop. Oh, great. What happened here? Now all my buttons shifted. This is really going to screw me up. Oh, man. I have a whole set of buttons for camera shots. Now I just screwed them all up. Anyway, here is what somebody looks like when they... Let's say I've got 1,000, so let's say 1,000 shares. The max I'll trade 1,000 shares of some stock, right? And you're all in, and you're like this. You're walking back and forth. You're, oh, come on, you can do it. Yeah, come on. Oh, another tick. Yeah. Oh, yeah, here comes the bid. Buyers are coming in. Yeah, S&P's ticking. Yes, it's good. You're all excited, right? You're stressing yourself out. Psychologically, I think it's just a huge load on you. Now, let's say it hits your target, and you take half off. All of a sudden, what happens is you go from this catatonic rock, which you're begging your screen, you're talking to your charts like it's in the same room, like I do talking to my San Francisco Giants, or they got their butts whooped by the Dodgers again. Ooh, serenity now. You're talking to your screen. But as soon as you take half off, you kind of pull this one. Lean back a little bit, and you're like, all right, yeah, okay, cool. You relax. Because you know you made some money. And I agree with you, Digital Pete. I think it's way easier if you take some off. And here's the thing. I could have a debate with somebody who would probably, I think Bob Dunn, if I think correctly, Bob Dunn doesn't like to, scale in and out. He's an all in, all out kind of guy. And we could disagree as friends on that philosophy. For me personally, I think psychologically it's much more beneficial to sell out of a little bit. Some of you are going to be the exact opposite, right? Some of you, it's much more beneficial mentally to just go all in and all out and be done with the trade. You have to find out what works for you. The thing is, as traders, we have to be introspective. I've mentioned this before. If you don't think that you have any issues, you got no problems, you're going to be great as a trader, then just start trading, because the market will expose your vulnerabilities right away. It will make you realize that you have problems, hopefully make you realize, because if you don't realize and you don't address them, then you're just going to lose your account, period. For me, early on, it was definitely my arrogance and cockiness with regards to the market. Outside my personal life, I'm so cocky and arrogant. Anybody who met me knows that. But with regards to trading, I'm not. I know that market is way bigger, more powerful than me, and will squash me as soon as I start getting arrogant, because it always does. So anyway, my 2 cents on it. I think that was it from a psychology perspective. Anything else from a psychology perspective you want me to get into? I just had 2 questions from Echo and Tiffany. I did the losing streak. Tiffany, I don't know if you're here today. Echo, hopefully that helped you out a little bit. Let's see. Dave says, I had a 3-month losing streak. Whew, yeah, 3 months is pretty rough. Cutting my risk in half and using my first target of 2-to-1 helped with that a lot. Hitting that gave me my house money to shoot for 5-to-1, and then I walk away. Right. And normally we'd say, well, stay to 3-to-1, but sometimes you just got to get that winner going, right? You really got to get that machine running again, because it's like, I don't know, in the old dating world, you see someone at the bar you want to meet, and you go up and talk, say, hey, can I get your phone number? And you get shot down. I got one of the guys I used to work with many, many moons ago. He would, I won't say it because it's pretty crass and crude, but he would go up to any girl at the bar, and he would say, do you want to go home with me? And I mean, everyone. And I was like, dude, you are embarrassing men around the world. He wouldn't even really ask their name. And you know what? Maybe out of 20, 1 out of 20 would say, okay, I'll go home with you. I'm like, God, I don't know how you do this. And first off, that's gross, but whatever floats your boat. For him, it was just a sheer numbers game, and he didn't care. And I think somewhat with regards to trading, we have to treat it as a numbers game too. I could take 100 trades, and I know I'm not going to be successful in all those. Hell, I mean, if I'm doing really good, I may be right on 75%. And to me, that is really good. If you get to the 75% win ratio, I think you're killing it. You're killing it. Now, we talked about this the other day. Just because I'm right on 75% of the trades doesn't make me a great trader. I now have to have that right reward-risk ratio. So what Dave's doing is he's actually increasing the probability of himself having winning trades. Why? Because he's only shooting for small targets, 2-to-1. Now, to get to that 5-to-1, well, what he's done is he's scaled out. I'll take off some at 2-to-1. I paid for the trade, and now it's all house money. And psychologically, Dave, that has totally helped you. I can tell by the way you wrote it, and I know that strategy and how that impacts you. So, good. Congrats. I'm glad you figured that one out. 2-week losing streak, but it hurt most when I lost gains and losses on initial in less than 4 days. Revenge, ego, market don't care, and life goes on. Yeah. NJ, what I would suggest is if you have a 2-week losing streak, take 2 days off and go do something where you don't think about trading at all, at least environment, like go to the beach or go to the mountains and do something that just removes you from all that. Now, one thing that actually I did, which I think turned it around for me, is I read Reminiscences of a Stock Operator, just because I like the story. And if you read through it, you'll see that this guy goes from borrowing a couple of bucks to making millions to losing it all, and then borrowing some more, making millions, losing it all. And I started to realize that here is a trader that somebody heralded as being one of the best in the world, the best trader of all time, Jesse Livermore. And I can't with good conscience ever say he's the best trader, because you can't lose all your money. You lose all your money one time, okay, shame on the market. You lose all your money twice, shame on you, right? That's the way I look at it for myself, is, I should learn at some point to stop my losses and slow down and get back to very minimal sizes. And once I get traction, I start to trade bigger and better, and Bob's your uncle at that point. So do you use statistics in my trading? Statistics? Yes. I use statistics in almost everything in life. I think that life is a statistics game. It's all probability. I love playing blackjack, and to me, blackjack's one of the easiest games to play with regards to probability and statistics. Once you know the numbers and what the odds are for every combination of hand that you have, it's really simple, and it's not like it's hard at all. For example, in blackjack, for example, there's 13 cards of each suit. Okay, well, that's easy. I just need to think in a spectrum of 1 to 13. and let's say I get I'm dealt a 14. Well, real easy. I can tell you what the odds of me busting are or not, right? 14. The goal is to get 21. I need 7 or less. 7, 6, 5, 4, 3, 2, or an ace. Well, 7 out of 13 is over 50%. So I actually have an over 50% chance of getting the card or not busting by hitting on a 14. Just pure statistics. Now, if I had a 15, I need a 6 out of 13. I've got like a 48% chance of getting the card I want. So I use it in trading. I use it in, hell, I use it driving down the freeway here in Southern California. Home of the best drivers in the world, by the way. It's all probability. It's all math, in my opinion. All right, I think I'm going to wrap things up here. We went longer than I wanted to, but let me, not that I wanted to, but here is what we've got cooking for tomorrow. Again, I think it'll be a relatively calm day. Well, my buttons are all, I'll have to fix this or I'm going to be a total mess the remainder of the day. Economic calendar for tomorrow, the 26th of July, brings us the S&P Case-Shiller Composite 20 Home Price Index. Very interested to see this number. They're expecting this number to decline. Now, my gut tells me it is going to decline, but not this much. I think it's just peaking right now. I've noticed that those home prices here are just starting to decline. So anyway, a year-over-year growth of 20% is still unbelievably high. You should not have that. Normally it's like 8%, 6, 7, 8% is like normal. We're well over double normal rates of return here. So this slowing down is a sign the housing market is slowing down, which of course impacts GDP. For tomorrow, you also have new home sales, you have consumer confidence numbers, Richmond Manufacturing Index, and other announcements as well. Here is your earnings calendar. So we do have, my friends, do we really have a popcorn trade of the day? Yes, we do. We've got a popcorn trade of the day after market close tomorrow. That's going to be Alphabet. They're reporting, and you can see there. There it is. It's the wrong chart. There we go. You can see there they're reporting after market. Google and GOOGL, which is Alphabet, reporting earnings. You also have General Motors, Coca-Cola, McDonald's, Visa, General Electric. So some major names tomorrow reporting earnings. Some of those before market, some after close. So pay attention, be very careful there with regards to that. Let me real quickly, how do you avoid revenge trading? I just don't do it. I know that it's going to hurt me. If I could line up 9 times out of 10, revenge trade is going to cost me more money. So if I have a losing trade, I'll just, to help, what I will do is I will just say, I'm just not going to trade that security today. So let's say I have a losing trade on whatever. I trade Google and I had some losing trades on it. My brain says trade it again, trade bigger, because you got to make up those losses. I never think about making up the losses. I don't care about that. The losses are a cost of doing business. If you think that way, I would have gone back at Google in that situation and where I lost and said, I'm going to trade you bigger. I'm going to trade more, wider stop loss. I'm not going to use a stop loss this time because I got to make that money back. Just don't do it. Just move on to something else. I'll go back and run scans, right? So if my scan and analysis of the markets brings up Google again and it's got a great setup, I'll take the trade with the same amount of entry risk that I would normally do on a position. Just treat it like it's a brand new trade. You can't think about the losses. Especially if they're big losses, then don't trade it. So let me go back a second. Let's say that, per my example earlier, I have a $250 per trade stop loss, $500 if I'm for the day as a day trader. If I lost $800 on my first trade in Google, and I go back to trade Google again, shame on me. I'm being stupid because I already violated my stop loss to begin with for the trade and for the day. I'm already down more than I should be for the entire day at $850. My stop loss is $500. So just move away from that, right? Move on to something else. Now, if I lost $250, which is my acceptable stop loss, I'll trade Google again or whatever stock it is that I lost on or security. But as soon as you feel like you find yourself saying these words, I got to get that money back, stop. That could turn into a revenge trade. One could argue it's more than... I agree, Chase. And I say usually most books will say it's 70%, some say 75%, some, depending on the week or how you're feeling, it could be 100% psychology. I mean, once you have your trading system down and how you analyze supply and demand or use indicators or whatever it might be, once you have that down, it's all mental game, right? Let's see, close the laptop or app and then play a video game or hit the gym. Yeah, hit the gym. Great way to deal with losses, hit that gym. Ed Thorpe, great trader, and he invented card counting. Oh, yeah? Cool. I think I covered everybody's question. What makes Google the popcorn trade of the day? Well, I've got this theory, not a theory, it's just something I call them all the time. The popcorn trade of the day is pretty simple. A popcorn trade is where you have an earnings announcement, and that security moves so much where you could see literally a 10, 15% swing in price in like 10 seconds after they report earnings. So I always called it a popcorn trade of the day, kind of my own little personal thing, where basically what you should do is you bring up your chart tomorrow. So here's your chart, and I'll make this go into after hours session. We'll make it a 5-minute. So here's a 5-minute chart. You turn this on to this is the dollar index. Let's go to Google. All right, so here's Google. And I turn on, down here at the bottom, you see it says RTH, which is regular trading hours. I will make it extended trading hours. And then what you'll see is these blue areas. That's what's happening like now, right? That's the after hours market. And I would just sit there and I would watch what happens. What you'll see tomorrow for Google, right now it's trading at $108. Well, tomorrow, let's say this is, the end of market tomorrow. This thing could jump up to 110, 115 in a matter of seconds and then come screaming back down. And this range that you see here, right? This whole thing is 1 day's range. Let me just do this. Okay, so let me bring up a daily here just to put it into perspective. You look out here, you look at some supply and demand zones that are much higher out there, like 115 right there. Boom, big level. You could say our lows from the past year right around 104. It may not seem like it, but tomorrow after market close, in literally seconds, this could ping pong all the way up to 115, all the way back down to 104. So I call it a popcorn trade of the day, which is basically grab yourself a bowl of Orville Redenbacher popcorn. I wish they would sponsor this program. Maybe I should just email them and say, Orville Redenbacher popcorn. All I need is free popcorn. I don't want money. Just give me some popcorn. Make yourself a bowl of popcorn. Put on Google on a 5-minute chart, 1-minute chart if you want. Put on extended hours trading. Put your feet on the desk, not so they touch the keyboard, but kick back and just watch it. Don't trade Google's earnings. You have no idea what's going to happen tomorrow. They could have blowout earnings, right? Let's say they have blowout earnings. They could shoot up 30% or down 30% with blowout earnings. They could have horrible earnings and shoot up 20 or 30%. You just don't know. Go to the dark side of the moon. See you on the dark side of the moon. All right, that's going to do it for me, everybody. Hope you enjoyed the session. Again, for Echo and Tiffany, thank you for asking those questions. I appreciate you sending those things in. Obviously, that helps steer the conversation for this program, and I generally try to make it viewer-based and keep it under 1 hour, which means I've got about 60 seconds left to wrap this one up. So if you guys have comments, questions, feedback, things you want to discuss on future shows, it's pretty easy. You can put your comments down below the YouTube video. I think that's the best thing. You can always hit like or subscribe if you are new. I saw some new names out here today. And you can always email me, TraderMerlin@gmail.com. Until then, happy trading, everybody. I'll see you on our Tuesday session. Take care.